Hey there, namaste, adab, sat sri akal to all my South India students, and this time the revision series for you are going to begin. And what a most important topic we are starting with, and that is economic value added. Asked by ICAI in almost last 3 exams continuously, very important in terms of concepts, very important in terms of understanding the sums. So now open your magic book and get started with the chapter performance measurement and evaluation. In that, open the concept of economic value added and let the game begin. If you do not have the magic book, my suggestion will be download it from my telegram channel. As in this concept of economic value added, I have added it, so you can use it from there. If you have not purchased it, you can visit the description box, purchase it. It will be very helpful to you. The best summary book that you can have for Scmpe quick revision in 1.5 days. So let the magic revision sessions for full English conceptually and chapter wise begin. See you all in the more upcoming sessions. Let's enjoy this one. Okay, so now we are going to start with the most important concept that has been asked in the examinations by ICAI for chapter number performance measurement and evaluation, and that is economic value added, EVA. Everybody? EVA. Alright, so now what exactly is EVA? This concept was developed by Mr. Stern and Stewart, who were in United States of America, got it copyrighted in their name. Now why exactly did this concept arose? Pay attention. Can I say accounting profit that we see is subject to manipulations, is subject to window dressing? Say me yes or a no. Yes. Correct. We are to auditors, chartered accountants, and we have to see a lot of things internally. Are accounting books subject to manipulations? Yes or no? Yes. Definitely they are subject to manipulations. Now suppose if I am an investor, and there is a company. See, I'll give you an idea. I told you some time back that I started investing when I was in articleship days. And I did not do some big investment. I used to purchase 1, 2, 2, 5, 5 shares of blue chip companies, wherein I knew that at least it will stay stable, it will not go down. And obviously, an articleship time you didn't have also much money. But my intention was start investing, so at least I'll get some knowledge out of it, and then I'll be called for annual general meetings. Wherever I get time, I'll attend that also. So that was my main intention. So now, as an investor, when I am investing in the company, can I say I will invest based on the information available to me of the company? Can I say in that I will see two major things. One, the profit and loss account. As a chartered accountant, what will be the first analysis that I am going to do? Financial accounting, financial auditing I will do of that company and then invest, correct? Or I will invest based on somebody telling me, hey, invest in this company. I will invest or what? I will invest on what basis? Financial basis. Are we understanding? So I will go through a company's financial profit and loss account, correct? And if it is positive, I will invest in that company. I will go through the company's balance sheet. Are yes or no? And if that is also positive, I will invest in that company. Are bolo? Yes. Now this is what I did for a company called as Satyam. Have you heard this name? Yes. Satyam scam, you would have heard. So that happened in the year say 2008, 7, 8, 9. At that point in time when I was in CA final doing my articleship, I had purchased shares of Satyam. I think I had around 4 to 5 shares of Satyam. Now I did not invest like that only. I had gone through the annual report of Satyam, and trust me, the annual report was very positive. They had good amount of orders, they had a good amount of financial profit. Stability was there, the balance sheet was looking healthy and sound. The ratios which we see in balance sheet, we see the current ratios, we see, yes? Yes, we see the liquid ratios, all of that we see, no? So actually those are evaluated and then you invest in the company. Everything was positive, but then one fine day scam broke and people were into losses. It didn't matter much to me because I hardly had 5 shares. So in 5 shares, it's not going that I am going to become some Warren Buffett or I am going to come on road. Neither thing is going to happen, and I knew that. But the point was that even though I had analyzed and still there was a scam, now as an investor, how will I come to know that they are doing financial fraud within? They had inflated the salaries by creating fake salaried people, and because of that their expenses they had faked, and then there was some financial irregularities. They had created a company in Malaysia called as Metas, Satyam, reverse Satyam it will become Metas. So they had created that, and in that some financial dealing was done, irregular financial dealing was done. Now as an investor I will not come to know. As an investor I saw the profitability, profit report, and everything was going good. This is where Stern and Stewart realized that just looking at on the face of an audited balance sheet and a P&L account will always give a positive signal. Who will report negative signal in its own annual report, where you only have to sign as a managing director? Are you understanding? So that is where Stern and Stewart realized that everybody wants to invest, but if the books are cooked up, then it can become an issue. Yes? So they researched and studied the balance sheet P&L account of a lot of companies, financially healthy companies, financially unhealthy companies, every company, and they realized that there are few adjustments that these companies are making, few window dressing adjustments. You understand what is window dressing? They are making a few window dressing adjustments, and they are manipulating the books of accounts and manipulating the profitability of the company, which is a big problem for any shareholder, because he will not come to know about it, right? So they created certain adjustments, around 155 to 160 adjustments were created by them, and they told that to the profit and loss account that you are getting from the annual report, do those 155, 160 adjustments, and you will reach to a level of cash profit or economic profit of the company. See, real profit of a company is the how much cash profit it is making. That is the real profit for a company, yes or no? Yes. So they thought that let us remove all the non-cash expenditures from our P&L account, remove all the things which are not contributing to the operational daily businesses, and they did around 155 adjustments. Based on those 155 adjustments, a company's profitability will near a true economic cash profit. It will near a true economic cash profit. Can then you rely on the financials? Because all the cooked up things which were done by the companies were analyzed by Stern and Stewart, and they gave a reversing effect on all of that. You understand? So if I have done a certain cooked up adjustment, window dressing adjustment, can I say it will get reversed by my Stern and Stewart EV adjustments? Are yes or no? So they did all of that, and then they realized that yes, now after adjustments the profit that we are getting is the real profit, and that shows whether the company is really adding value or not. Now looking at this, a lot of investors started using that. And looking at the popularity, they copyrighted EVA. The reason of copywriting EVA was that they told that if you want to call any working as an economic value added, it has to be of the adjustments that we have done. Even if one adjustment is made additionally or removed from that, then it will not be called as a EVA, because now it is copyrighted, and copyrighted thing means do as it is. And if you want to call it as an economic value added, which we have copyrighted and trademarked, you have to follow these adjustments only. Suppose if I feel that no, out of these 155 adjustments, 150 adjustments are correct, but 5 adjustments are not correct, and 5 adjustments I want to additionally make. Can I do that? No. Then it will be called SVA, Sankalp value added, not economic value added. Are we understanding? So economic value added, you have to follow what Stern and Stewart did. What was their intention? To do adjustments to the P&L account in such a manner that the unwanted financial irregularities will be removed, non-cash things will be removed, and company will try to reach to a level of real economic cash profit, to the level of deflated balloons. Please, everybody. Are we understanding, guys? And that is where they came up with the idea of economic value added, and there was a lot of research behind their backing, behind whatever adjustments that we do. So sir, now we will also have to do 155, we will also have to learn 155 adjustments. No, for our exam purpose, IC has given some 5 to 6 adjustments. Just follow them and solve any question of EVA. Ting, 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 ting. Okay, so we will do all of those adjustments, which will help you to solve all the questions, of economic value added, which we will solve and we will be through. Are we ready, everybody? So now pay attention, So what is economic value added? So they came up with their own profitability adjustments, correct? So a normal EBIT will be picked up from the P&L account of the annual report. We can get that. Reo, chartered accountants, have you seen an annual report ever in your life? Yes. Very, very happy to hear that. Have you seen a P&L account in that? Very good. So in that, can we find out the EBIT? Yes or no? But that will be the EBIT as per what company has done. To that, we will do our adjustments as per Stern and Stewart. After those adjustments are done, Stern and Stewart coined it as NOPAT, and called this net operating profit after tax. To this they reduced that, okay, NOPAT, from the business we have earned the real economic cash profit, but to this we will have to pay off the investors of the business, like the debenture holders will have to pay interest, like the equity shareholders we have to pay them the dividend, to reserves and surplus we have to give them dividend, to the preference shareholders we will have to give them preference dividend. So they said that all the capital employed is there. To them, we will calculate a weighted average cost of capital, pay off them, and whatever is left will become your economic value added in real terms. First, through NOPAT, find out the real economic cash profit. Yes or no? Yes. Then, through that real economic cash profit, give the cash to the owners of the capital. After giving everybody, whatever remains is your real value addition. And in this, you have to give to the equity shareholders also based on the dividend that they are expecting. Give to the reserves and surplus also. Give to the preference shareholders. Give to the debenture holders. Give everybody their share. Then net, what remains will be your real value addition. And then if it is positive year on year, we can be contented that yes, the company is doing good. We will invest in that company. Did you understand how it all started? Everybody, yes or no, yaar? Yes, sir. Now, so what is the formula for EVA? NOPAT minus capital employed into weighted average cost of capital. Can I have it in chorus and a bit more louder version? Please, everybody, start. What is the economic value added? NOPAT minus capital employed into weighted average cost of capital. Are we clear, everybody? Yes, sir. Done. Now, let us break NOPAT. Let us first understand what is NOPAT. Let us understand capital employed. Let us understand weighted average cost of capital. Combine them, we will get EVA. Cool? We will get EVA. Cool? Okay. So first, let's start here. So first he told that from the books of accounts, pick up the, so we are understanding NOPAT. We are trying to understand. So he said that first from the books of accounts, pick up the EBIT, called as earnings before interest and tax. Pick up the EBIT, which is called as the earnings before interest and tax. Are we clear, everyone? Okay. To that they said, if focus on me. I'll give you the time to write because we are laying down the concept. If your focus is there, then you will not be able to focus on the things that I am saying, right? And then as a matter of writing, you may miss out on some concept which I don't want, because concept is more important. Writing part can be given to you anytime. In fact, writing part is any which case available here also. I am not going to write anything new or something that I am going to create on my own. So let's focus on the concept part first, then we'll take it forward. Okay, ma'am? Okay. So we start with EBIT. Where will we pick this EBIT from? From the annual report, profit and loss account, we'll pick the EBIT. To this we will reduce the interest. Which interest? Can I say interest on bank loan, interest on debenture? Are yes or no? To this we will get what? EBT. To this we will get what? Earning before tax. We know this structure, right? Less we will reduce what? Tax. We will get what? Profit after tax. Okay. Now to this we will add back the interest net of tax. I will tell you the reason. To this we will add back the interest net of tax. So where is this interest? This interest I am speaking of. This interest net of tax I will add. Say for example my EBIT is 1000 and my interest is say 100. Assume that company has say debentures of rupees 1000 at the rate 10% interest. So what will be the interest amount? 1000 rupees debentures are issued to the debenture holders, on which we are paying 10% interest. So ladies and gentlemen, what is the interest amount? 100. Are we understanding, guys? Yes or no? Okay, so I have reduced that 100 for the purpose of calculating tax, because that interest is tax deductible. This interest of 100 is tax deductible, yes or no? So what I will do is I will deduct this. I will get 900. To this say tax is say 30%. So I will reduce 270. I will get 630. To this I will add interest net of tax. So interest net of tax means 100 minus whatever tax amount percentage was there, which is 30%. So I will be left with 630. I will add this, I will add 70, to which I will get a NOPAT of 700. So sir, why did you add back this interest? And why did you add back this interest only net of tax? Is what is running in your head? Or you have understood it, then we'll move on. No sir, please sir, we want to utilize the fees that we have paid to you. How can we say we have understood everything even if we have? But sir, genuinely this time we have not understood. So you want me to take it forward, right? Pay attention. So what happens is this, see, try and understand the total economic value added format. It is NOPAT minus capital employed into weighted average cost of capital. Can I say this capital employed will also include debenture? This weighted average cost of capital will also include interest, but this interest that we are going to take is post-tax interest. It will be post-tax interest. So can I say the post-tax interest, what did I say? Post-tax interest, we are any which case reducing from here. Arey bolo. So if I reduce it from here also, then I reduce this post-tax interest from here also. Can I say it will be double deduction? Double deduction should never be allowed. So what we will do is this post-tax interest which we are going to reduce here, we are adding it back to nullify that effect. But why are we reducing this here? To give the tax benefit. Because is interest a tax deductible expense? Yes, it is a tax deductible expense. It is like your capital budgeting depreciation. In you know chapter called as capital budgeting. In that you calculated net cash inflows, wherein EBIT less interest, then you used to reduce depreciation just for the purpose of tax, because tax is allowed on depreciation. Then you add back depreciation, NPAT, add back depreciation, non-cash expenses are added back to get the net cash inflows. Do you remember that? Yes. In the same way, we are adding this interest net of tax, because this interest is any which case will be deducted here as a post-tax interest. Are we clear? So now what is the format for NOPAT? You will pick up what? EBIT. You will pick up what? EBIT, earnings before interest and tax. To that you will reduce what? Interest. We will get what? To that we will reduce what? Tax. To that we will get? To that we will add? Okay, why will we reduce interest net of tax? Why will we add interest net of tax here? So that we don't get a double impact, because we are now any which case going to reduce it when we calculate the capital employed into weighted average cost of capital. To that we will get what? Net operating profit after tax. Are we clear? So then where are those 155 adjustments, sir, that you were fearing us of? I told you not 155. We have to do only 5 to 6 adjustments. Those adjustments will be done separately, but they will be adjusted with EBIT. They will be adjusted with EBIT. So what we will do, EBIT, add less those adjustments, we will get adjusted EBIT, and then the format will continue. Did you understand? So if I have to write NOPAT again in a proper manner, can I say I will take EBIT as per annual report? To this, what we will do? Adjustments as per Stern and Stewart. Are yes or no? Which are approximately 5 to 6 adjustments. What we will get? We will get the adjusted EBIT. Are yes or no? To this, I will reduce the interest. To that, I will get the earnings before interest. To that, we will reduce the, I will get the, to that, we will add the interest. Which interest? Net of tax. To which I will get the net operating profit after tax, after all the adjustments that we wanted, after all the adjustments that we wanted. So can I say, first let me understand the NOPAT format. Are we clear with the NOPAT adjustment? Are we clear with the NOPAT whole format? Now this adjustments which is pending, which we will tackle separately. So those adjustments will be tackled separately. Once you are through with those adjustments, just directly put it here. The format of NOPAT is clear, no? Now only those adjustments are left. Those adjustments again, I will take separately those adjustments. Then when you are done with this, just replace it here and you will get the NOPAT format. Are we clear? So can I say, in understanding of the concept of EVA, I can put a tick mark on NOPAT? Less. What do we reduce? Capital employed into weighted average cost of capital. Yes or no? Now let's take an example to understand that also. What are the kinds of capital that a company employs? Equity share capital. Then debt, debentures, correct. Then bank loans, yes. Bonds, correct. Then preference shares, correct. Reserves and surplus is also kind of a cost of capital only. Yes or no? So if I write here sources of capital as you have told me, can I say one will be equity? Can I say other will be reserves and surplus? Can I say other will be preference shareholders? Can I say other will be debenture holders or bonds? Can I say I can also have bank loans? That's it, almost all done. Yes or no? Yes, sir. Let's continue this with an example. Let's say sources of capital is given. Now I will write down the amount. Let's say I have say 10 lakh of equity. Say I have say 5 lakh of reserves and surplus. I have 8 lakh of preference shares. I have say 12 lakh of debentures and bonds, and say I have 4 lakh of bank loans. Calculators, please tell me what is the total capital that I have. Calculators, please tell me what is the total capital that I have. Correct. It is, just a moment, I think you have calculated it incorrectly. My calculator is showing me 40 lakhs. Please can you do it again for me? It is showing 40 lakhs. How much it is showing? 40 lakhs. Come on, yaar, can't even do simple additions properly, man. What, man? Bloody article clerk. Chalo. So are we clear with the amount? Now we want to assign the weights. Now we want to assign the weights. So how do you assign the weights? Can I say total equity is 10 lakh out of a total capital of 40 lakh? So 25%. But how that we can do, but can I say it is basically 10 lakh divided by 40 lakh? This is how I got it. So can I say this works out to 25%? In the same way, this will become 12.5%. 8 lakh will become, correct, 20%. 12 lakh will become 30%, and this will become. Are we clear or what? I am talking to CA final students, right? I can at least go in this space, right? So this will complete my 100%, right? Then we will write down the cost of capital. We will write down the cost of capital. Hey, this format you would have drawn, no? In your intermediate. Yes, now you have become experienced big people. So what is the cost of capital of equity? Dividend. So say dividend is how much? Tell me. So I'll just write here that dividend how much? 15%. See, equity shareholders are the risk takers. Let's give them more, no? Yes, so we will give them 15%. Same risk is taken by reserves and surplus, so same 15% will come here. Chalo, preference shareholders will be called as preference dividend. 10% enough for them? Okay. Then debenture interest or bond interest? 12%. Chalo, we'll give them 12%. Bank loan, bank interest, it will be called as how much we will give them? That's it? 8%. Are we clear? And now are we all set to calculate the weighted average cost of capital? Can I say, if I tell this as A, this as B, this as C, this as D, my weighted average cost of capital will be C into DER? Are bolo? Okay, so 25% into 15% will give me how much? So you can also do 0.25 multiplied by 0.15. I am assuming you are at CA final level, you would know this much multiplication, or you want me to teach you that also? Then please give me some extra fees for teaching maths also. So are we clear? 25% to into 15%, 0.25 into 0.15, or whichever you are comfortable, works out to how much? 3.75%, or it can also be called as 0.0375. Yes, keep on doing for reserves and surplus. 1.875. Continue. 2%. Then 3.6. Then 1%. Total will be. Sorry. So can I say 12.225%, everybody? Here itself, I know the capital employed. How much? 40 lakh is my total capital employed. Multiply by weighted average cost of capital, which is 12.225%. You will get how much? 4 lakh. Are we understanding? So can I say with this, I will say that I am clear with capital employed. I am clear with weighted average cost of capital. In short, I am clear with economic value added. Now the last thing that I have to teach you is adjustments of Stern and Stewart. Once I teach you that, then any sum of EVA you will be able to crack it, macha? Are yes or no? So with the flow, let's get that also done and dusted. Yes, chalo. So now I am going to teach you the adjustments as per Stern and Stewart. Adjustments as per Stern and Stewart. So we will come here. Points, can you see this points to be kept in mind? Are bolo? This basically points to be kept in mind, which is there no here. These points to be kept in mind are nothing but your adjustments by Stern and Stewart. Shall we take it one by one? Okay, let's start. First, if profit after interest and tax is given, add back interest net of tax. Do we know that? Arey Baba, if the question, if it gives you profit after tax, if it gives you this profit after tax, then what will you do to get NOPAT? Add interest net of tax. So first point to be noted is done. Can I put a tick mark? Okay. Second, always remember opening capital employed is to be taken. See, it is a copyrighted trademark thing, so we cannot use much of our brain. I feel it should be average capital employed, correct? But Stern and Stewart feel no, opening capital employed is given because it takes a lot of time for the capital employed to recover the cost that they have invested or cost amount of money that they have invested into. So we will always take the cost of capital, which is opening capital employed. Examiner will give you both. What? Opening capital and closing capital employed. We may be tempted to either take an average or a closing, but is it our father's trademark or copyright? So we'll have to go as per Mr. Stern and Stewart. Are we understanding? What did Stern and Stewart say? So we will use that. Are we clear? So in the question, when you calculate NOPAT minus capital employed, this capital employed, are you seeing? This capital employed, if they will give you opening capital employed, they will give you closing capital employed, they will give you average capital employed. Do not get tempted to use average. It is always opening capital employed as per Stern and Stewart. Are we clear? Are we clear with the second adjustment here? Okay. Third, add back non-cash items and accounting depreciation if included in operating profit and deduct economic depreciation. Are you seeing at this third point? Now what exactly is this? I'll explain you. You start your NOPAT calculation by picking up EBIT. Yes. So can I say EBIT is nothing but like your P&L account only, yaar? Correct? You have your incomes, gross profit here, you have your expenses here, and whatever net profit that you get it here. Are yes? Yes. Can I say this net profit also includes some non-cash items which are debited here? Yes. What will you do to that? You will add back the non-cash items, because Stern and Stewart say we want to go towards real cash economic profit. So for that we will remove all the non-cash items. They have also said that if there is any accounting depreciation, add back that accounting depreciation, but they say that we will allow the economic depreciation. Now we have never heard the term economic depreciation. Let's understand that. What happens is this: suppose I purchase a machinery. Now as per books of accounts, we have typical methods like SLM, WDV. Suppose a company A is using straight line method. How? What? Straight line method. The machinery life is 10 years. How much? 10 years. So can I say SLM will say you to charge 10% every year? Yes or no? So suppose if I have purchased a machinery for 100 crores, how much amount will be debited in P&L account in the name of depreciation? This is called as accounting depreciation. 10 crores will be debited as per our accounting method of straight line method, SLM. Are we clear? But now a lot of Ind AS and all of these things have been introduced. Are bolo? Now a lot of Ind AS and all of these things have introduced, which say that economic depreciation means actual how much life of the asset has gone down. Based on that, how much actual life of asset has gone down, based on that we should calculate the we should calculate the depreciation, called as economic depreciation. Now over a period of time we are seeing that this machine will only have a 4 years life, because on an average 10 years is correct, but if the asset is used for 8 hours daily, which is a general usage, but we are a company which wants to manufacture things quickly, 24 hours our machinery is running. Our machinery is running for 24 hours. So if it is running for 24 hours, can I say it will not be able to survive for 10 years? It will survive only for 4 years. So economic depreciation will become how much? Can I say it, if we are going 100 crores for 4 years? Correct, 25 crores. Are we understanding? So they are saying that please, you are allowed to reduce 25 crores because that is your genuine depreciation. That is your genuine depreciation. But will an SLM ever admit that a machinery which is purchased has a life of 10 years, you will depreciate it for in just a span of 4 years? It will not, because the accounting terminologies will go according to that. So suppose if you have debited accounting depreciation as per 10 crores, do you accept this as per EVA? No. So can I say we will add this back? We will add this accounting depreciation back so that the accounting depreciation's effect is nullified. Yes. Are we understanding? And we will reduce what? We will reduce what? Economic depreciation, and that is a genuine. So can I say we will reduce that from our net profit? Are we understanding? Yes. Now instead of 4 years, I feel my machinery is being used only for 4 hours daily. So instead of 10 years, my machinery will be used for 20 years. Are we understanding? So that will increase the life of the asset more. So that will reduce my economic depreciation. So that is also a possibility. Are we clear, everybody? Say yes or no? Yes, sir. So are we clear with that adjustment? Now let's read that adjustment again. Add back non-cash item, correct? So if it is debited to P&L, add back non-cash item and accounting depreciation if included in operating profit, and deduct economic depreciation. Are we clear? Cool. Next adjustment, accrued tax add back, tax paid deduct. See here. Can I say in our P&L account, at times we make this provision for tax. This is basically your accrued tax, say 10 lakh provision for tax or accrued tax, correct? They are saying if your net profit say is 35 lakhs, includes this provision for tax or accrued tax, what will you do? Add it back, because this is like a non-cash adjustment, add back. But you would have actually paid some tax. Whatever tax you have paid, say tax paid is actually 8 lakhs or tax paid is actually 12 lakhs, whatever it is, you are allowed to reduce. So whatever is debited to P&L account, accrued tax, add back. Are we understanding? And whatever is paid is really allowed to reduce. Are we clear with this adjustment? So we will say this adjustment is also over. Are we clear? Then last adjustment is, pay attention. If there is any deferred revenue expenditure, you understand what is a deferred revenue expenditure? Like big advertisement, like big R&D expenditure. So now if I start a company and I do some big adjustment and big advertisement and everything, is it only relevant, going to be relevant only for 1 year, or it will be relevant for years? Are we understanding? It will be relevant for years. So I should not write it off like that only. No. So what does deferred revenue expenditure say? That at times what companies do is this. What companies do is, suppose there is a deferred revenue expenditure, huge advertisement of 25 lakh rupees is done, which will continue for, with the benefit of which will continue for 5 years. But at times company debit full 25 lakh to P&L account. Companies debit full 25 lakh to P&L account. Is this allowed? So they are saying that if such an adjustment is done, that you have debited the P&L account in, we have debited the deferred revenue expenditure in the P&L account, add it back. You will add it back. See this adjustment now. Deferred revenue expenditure, if debited in P&L, should be added back. It could be advertisement expense, it could be R&D expense, it is added back. Are we clear everybody? Yes or no? Say yes or no? Yes, sir. Okay. Then if there is any previous year adjustment not done for any non-cash item or provision for doubtful debt or deferred revenue expenditure, then that is also added back in opening capital employed. Now we are going to do a sum. We will be clear with this adjustment also. But what is the adjustment? If previous year adjustment is not done for a non-cash item, for a provision for doubtful debt or for a deferred revenue expenditure, add it back in opening capital employed. Are we clear with all the adjustments? So Stone and Stewart gave us these 5 to 6 adjustments which ICA has taken. Once these adjustments are done, can I say we will get our adjusted EBIT? From that adjusted EBIT we will get to NOPAT. We have calculated capital employed, we have calculated weighted average cost of capital. Can I say we will be able to calculate the economic value added? Everybody macha, are we clear everyone? Yes. Say yes or no? Yes, sir. Perfect. Clear? Now sums part, we'll come to that. That's a different thing. But in theoretically, are you clear with all the adjustments, with all the things that are there? Yes or no? Yes, okay. Some limitation of EVA, it is an absolute measure, so comparison may become difficult and based on historical data. They've just given it for the sake of it. Now a good point which can be asked as a theory in the examination is how to increase EVA. How to increase EVA? See, realize one thing, that EVA end of the day is dependent on 3 characters: NOPAT, cost, capital employed, weighted average cost of capital. These are the 3 things. Now see how to increase EVA. First, increase NOPAT, keep capital employed as it is. So automatically my EVA will increase. Increase NOPAT, keep capital employed as it is. So my EVA will increase, yes or no? Because my profit is increasing. So NOPAT will increase, minus capital employed into weighted average cost of capital is same as it is. Are we clear? Okay. Second, for NOPAT, increase your NOPAT more than the capital employed. So suppose if my NOPAT is there, my capital employed into weighted average cost of capital is there. What they are saying is, suppose if you are increasing your capital employed On that capital employed, your NOPAT should increase more. Currently you are earning 10% NOPAT on a capital employed, and suppose more capital employed you are infusing, earn on that new capital employed, try to earn more NOPAT than regular. So instead of 10%, try to earn 12%, automatically your EVA will increase. Are we understanding? So what they are trying to say, increase NOPAT more than capital employed. So if capital employed is increased, that's okay, but increase your NOPAT more than the capital employed. Are we clear? And third is keep NOPAT as it is, reduce your capital employed. Remove unwanted capital employed. So if you remove unwanted capital employed, again your NOPAT is same, but your capital employed has gone down. So cost of capital employed will go down. So WACC into capital employed will come down. NOPAT is as it is, automatically your EVA will increase. Are we clear, guys? Are we clear with WACC, weighted average cost of capital, which is weight of equity into cost of equity plus weight of debt into after tax cost of debt? Are we clear? See here, when I am writing this interest, always remember the interest will always be net of tax. It will always be net of tax. So net of tax is after tax cost of debt will be taken. And the last is EVA is equal to EBIT minus interest is equal to EBT minus tax is equal to EAT. Correct? Plus interest net of tax will give me NOPAT. Are we clear, everybody, with EVA? Are we clear with all three financial indicators of financial measures? Yes, everybody? Yes, so with this we complete all our financial measures. We complete all our financial measures.